Welcome to The Explainer. Today, we are going to crack the code on how companies really work. We're going to dive into what's called the financial Trinity, a powerful set of tools that lets you see the secrets hidden right there in the numbers.
So, let's just jump right in with a puzzle, one that trips up even seasoned investors. How is it possible for a company to be reporting record profits? Looking amazing on paper, and then suddenly go bankrupt? It just doesn't sound right, does it?
Well, it's not only possible, it happens. And there's a name for it in Japan, kuroji tosan, which literally means black ink bankruptcy. It's when the profits are written in black ink, looking good, but the company collapses because it ran out of cold hard cash to pay its bill.
So how do we spot this before it's too late? How do we solve the mystery? Well, we can't just look at one number, like profit. We need to give the company a complete health checkup. And our tools for this checkup are its financial statements.
Think of this as our diagnostic kit. Inside, you'll find three crucial reports. Together, they're known as the financial Trinity, or Zaimusanpyo in Japanese. And you absolutely need all three if you want to see the complete picture of a company's health.
So what's in the kit? First, there's the profit and loss statement. This is like the movie of the company's year. Then you have the balance sheet, which is more of a snapshot, a picture of its finances on one specific day. And finally, the cash flow statement. This tracks the company's lifeblood, the actual cash moving in and out. Each one tells a totally different part of the story.
All right, let's grab our first clue. This is the one most people know, the profit and loss statement, or P&L for short. This is the document that tells us, is the company any good at making money?
So remember how we called the PL the movie? That's because it shows what happened over a whole period, like a quarter or a year. It starts right at the top with total sales, and then it's like a waterfall. It subtracts all the different costs until you get down to the very bottom line, the final profit.
But here's the thing. Profit isn't just one number. There are actually 5 different levels you need to look at. You start with gross profit. Basically, is the product itself worth selling? Then you get to operating profit, which is huge. It shows if the main business is healthy. From there, you keep subtracting things until you get to the final net profit. Each step gives you a new clue about where the company is strong or weak.
Now, listen up, because this is probably the most important thing to understand about the PL, and it's a massive piece of our bankruptcy puzzle. The profit you see on this page is not the same as cash in the bank.
Why? Why isn't profit cash? It's because of an accounting rule called accrual basis accounting. In Japanese, hasei shugi. The rule says a company gets to record revenue the second they make a sale, not when they actually get paid. So a company can send out a huge invoice, post a massive profit, and look amazing on their P&L, all while their bank account is totally empty. And that is exactly how a black ink bankruptcy begins. Okay, so if profit can be a bit of an illusion, where do we look for the truth? That brings us to our second clue, the balance sheet, or the B/S. This isn't a movie, it's a snapshot. It tells us about the company's stability at one precise moment in time. The balance sheet is built on this really elegant, simple idea. On one side, you have assets. That's all the stuff the company owns. On the other side, you have liabilities and net assets. That's how they paid for all that stuff, either with debt or with their own money. And here's the golden rule. Those two sides, they have to always balance, to the penny.
What's really cool is you can literally see a company's health in the shape of its balance sheet. For assets, a healthy company looks like an inverted triangle. Why? Because you want lots of liquid assets, like cash, at the top, ready to go. You want fewer fixed assets, like big heavy buildings, at the bottom, tying up your money.
Now let's look at the other side, how all that stuff is funded. Here, you want the exact opposite. You want a normal, stable triangle. That means it's sitting on a wide, solid base of net assets. That's the company's own capital that it never has to pay back. If a company has a tiny sliver of its own money and a huge mountain of short-term debt at the top, well, it's top-heavy and dangerously unstable.
All right, it's time for the final piece of the puzzle. This is the one that really solves our mystery of the profitable bankruptcy. It's the cash flow statement, or CF. This is where we stop messing around with accounting rules and we start following the actual, real cash.
The cash flow statement does something really smart. It just sorts every dollar that moves into one of 3 simple buckets. First, operating cash flow. Is the day-to-day business bringing in cash or burning through it? Second, investing cash flow. Is the company spending cash on things to help it grow in the future? And third, financing cash flow. Is it taking on new loans or paying old ones off? And this table right here, this tells you everything at a glance. Look at a healthy, growing company. It's generating cash from its operations. It uses that cash to invest for the future and to pay down debt. Positive, negative, negative. Beautiful. But now look at that bottom row. A company in danger. It's losing cash from its main business. It's having to sell things off or borrow more money just to stay afloat. That is the telltale heart of a company in trouble.
So we did it. We've got our 3 clues: the P&L, the BS, and the CF. Now it's time to put them all together and make our final diagnosis.
Here's how it all connects, how the whole system works. The PL might shout, "We're profitable," but then the cash flow statement comes in and asks, "Oh yeah? Did that profit actually turn into cash in the bank?" And all the while, the balance sheet is standing by, telling you whether the company is built on a solid foundation or a house of cards.
This is why you can never, ever just look at one of these statements alone. The real skill here is something called Rensa Shiko, or chain thinking. It's about seeing how one action flows through all 3. A big sale shows up on the P&L as profit. If the customer hasn't paid yet, it sits on the BS as a receivable, and it only hits the cash flow statement when that customer finally pays the bill. You've got to follow that chain.
So let's go all the way back to our original puzzle. The next time you see a headline screaming about some company's record-breaking profits, you're going to know better. You'll know that profit is not the end of the story. And your first question won't be, "Wow, how much did they make?" It's going to be, "That's nice, but show me the cash." And now you know exactly where to look.